Okay, so part three. Here we are looking at the macro outlook. And of course, the stock markets had a really steady week last week with an extra boost on Friday. That PCE data, yeah, to be honest, it wasn't far off of expectations. But, it did cause another rally in practically every asset class. Even gold had a rally. To be honest, it only seemed to be the dollar that sort of gave up the week's gains. Now, I've mentioned it before, but I can't change my mind on this. I still think that America has the strongest economy. Now, which is going to be problematic for inflation because, the Americans still seem so keen to spend. And of course, with employment, again, obviously Friday could change that, but we need to see what that comes out at. But that, there's just such a hot jobs market still at the moment, even though there's less jobs available. That ratio from 2 to 1 down to 1.6 to 1 of jobs available versus how many are unemployed. But for me, I can't believe that the dollar's not stronger personally, and that inflation's going to struggle to come down at the moment. I mean, just look at all the data that comes out; it's still so strong. But I think it should save them from a deep or a long recession, which may not be the same for Europe. Again, the closer inflation does move towards that 2% target set by the central banks, the stickier it's going to become and the harder it is to achieve, just that final push to get there. And of course, remember, it's got to stay there. If you're looking at the monthly, it's got to be 0.17% for a series of months to get that back to that 2% target. Now, there's still more hikes in the pipeline. The central banks refuse to concede to inflation, even if it means that inevitable recession will follow. And not only that, but remember, rates will stay higher for longer. That said, are rates really high though? I think it's just because we've simply got used to low rates. Obviously, we like low rates if we're borrowing. Not so keen if we're a saver though. And I've got to keep reminding that low rates are reserved for a crisis. So when we look at 5-6%, are they high or are they just back to where they should be now that any current crisis seems to be sort of almost out the way, obviously apart from Russia, Ukraine, that is. So, when we're still looking at inflation, I do doubt that corporate greed will disappear anytime soon. And of course, now they've had a taste of all those juicy increased profit margins, they're not going to give them up without a fight. They're not going to be prepared to accept less. Indeed, they've increased prices to actually compensate for lower demands to keep their profit margins high. Of course, that's the opposite of what they used to do before. They sensed there was less demand, they would lower prices to attract that demand back in. But now it seems they're willing to actually hike prices. And of course, we've all been brainwashed that inflation is here and to expect to pay higher prices. So, of course, like the little lambs we are, we do follow. Now, there's plenty of PMIs out this week with manufacturing and services. As I say, they're diverging. Can that continue? It just seems as though it can at the moment. Manufacturing sector is under so much pressure. But of course, that lack of workers does keep wage claims high. Now, of course, all that sort of US employment data that's coming out. So, watch the ADP on Wednesday and the JOLTS. Watch those initial jobless claims. And, of course, NFP for how strong that job sector really is. I mentioned in the earlier parts, but for me, I focus much more on the hours worked and the hourly earnings because they're inflationary data. So for me, that's more important. But I also will focus on sort of, how many jobs are on offer against how many are unemployed. I like that ratio. It did get to 2 to 1, but Powell mentioned in his testimony that it's dropped down to probably around about 1.6 to 1 now. So US banks passed their stress tests. I just wonder if the Fed and all these other central banks could pass a stress test. When you consider the amount of treasuries they've got on their balance sheet from over COVID, so at very low rates, 2%-ish on average probably, and they must be costing them absolute tens, if not hundreds of billions. Now, the lagging effect of all these rate hikes is still yet to be fully felt in the economy. And, even though the rate hikes may stop soon, it's possibly, because of that delay coming through, it may be too late to prevent recessions, even if inflation does drop a bit more. Now, I expect a deeper and longer recession for Europe, the UK included, and of course other countries. For me, I just think that the US might sort of just touch it, but I can't believe that they're going to go into a deep or a prolonged recession at the moment, given sort of the data that's coming out and just purely just looking at their economy. And of course the country and households are still awash with either cash or just through the sort of valuations of all the assets that they do own. And that's even taking into account, house prices dropping. So for me, I believe that the dollar should be higher. However, who am I compared to the market? So, I'm just one person. So only time will tell on that one, I think. Now, another point to think about here is it's only around about 16 months to the next US election, which, does seem a long time, but, those US elections, they go on and on and on. It almost seems like forever. And of course, Biden will be very keen to keep the economy solid as they get closer and closer to the election. So, that those challenges that are coming through, he's going to do his best to prevent the US going into a recession as much as he can, that is, of course. It's not so much up to him, but, it's going to be interesting. I think they need to get younger presidents. If they get them any older, they're going to be in 3 figures. Okay, so moving on, China continues to struggle and still suffering from that protectionism, as countries are really sort of trying to create their own domestic industries that they've in the past have relied on from Asia, and of course they want to do that in case there's another crisis and that risk of disruption to the supply chains comes back. And I think that's highlighted with the US and the EU. They were spending absolute billions to develop the semiconductor industries. And of course, I suppose as more and more vehicles, everyone wants EVs these days, that the semiconductors are going to become even more important. Then US manufacturers, to sort of highlight that, they're spending more than double. And even Chinese companies are diversifying out of China, just to sort of cover themselves a bit more. Now, I mentioned this earlier, but, those riots in France will impact their economy. And, Macron continues to lose more and more support each year. At the last election, he was lucky to get voted back in, let's be honest. If voters, the French voters, hadn't feared Le Pen, I doubt whether he would have been re-elected, because it doesn't seem that many people are happy with him. I just think that they was probably a bit scared of the alternative. And of course, when you look at some of the problems that are flaring up there, the pensions, of course, this recent shooting last week, and they're just a couple of the key issues with what the French citizens actually have with their president. There's a lot more. I think there's a really deep undertone of dislike for him moving forward, but he's still there. Now, Japan is showing signs of recovery. That's despite sort of weaker production. Now, they do have a tight labour market, and although industrial production was lower than expected at 1.6%, I just still can't believe that they're not prepared to sort of move their rates back up above zero. Finally, sort of look at the last couple of bits. Then even gold managed to rally towards the back end of the week. It touched 1900, but then it managed to recover a bit on Friday. Again, just the data just took it up with the PCE. And Bitcoin sort of remained. It sort of traded either side of 30k. The negatives, positives going. You've got the SEC on one side, and then on the other side, you've got those applications for ETFs that have gone in, especially the one from BlackRock. So, that's gone into a little bit of a limbo, really, because the SEC seems to be trying to delay it rather than refuse BlackRock. So I'm sure there must be some interesting conversations going on between the two of them. BlackRock have such a high ratio of success when it comes to launching ETFs that, and the size of them, obviously, it's a challenge for the SEC to actually refuse them. However, we all know their stance on crypto at the moment. So once again, I'm not going to go through all of this. It's you can just read it. Just if you've got anything that you want to find out about or you want to improve on, then just reach out to us. That's the easiest way. Our contact details: info@cymaxfintech.com, or just aim anything directly to me at chris.tubby@cymax-int.com. Hopefully you'll stay with us for the chart analysis that I do on a variety of products.